Welcome to the Twomey Stock Market Report. I'm James Twomey, and today's July 29th, Friday, 2022. Well, I think we've got a lot of data out there that is telling us a few things. One is, yes, we have inflation. Yes, we have a hot economy. And yes, we have a hot stock market. So what do we do now? It seems as if we've got no choice but to go back to our buy signals on the long side and start nibbling. It is a little risky. The upside is probably capped from this point forward, but we can't fight the data. So we're going to expand some of those topics, but let's just review. Again, we've got the information. We did the employment numbers and the PMI are still on the precipice out there. We've got pretty good employment. Some companies are pulling back, especially on the high-tech side and hiring. But in reality, we haven't had wholesale losses of jobs, and we haven't had wholesale catastrophic corporate debacles like in the housing crises and other, the dot-com crises. So the catalyst really here for this recession is high prices, inflation, and many causes of inflation. And we're not going to review them all here, but they're macro and they're environmental, the Twomey investment process, right? Look at the overall trend over the past 6 months to a year. That gives you the big picture. Then we look at what's all the macroeconomics, what's happening in the economic fact. Are rates going up? Are they passing legislation that's going to change banking behavior? Then we look at what's happening as far as sentiment out there, and then the environmental factors. What are the little things that are affecting this? Are we changing the war on fossil fuels? This move towards battery operated systems when we don't have the infrastructure or the capacity or the technology at peak performance to make that really 100% transition. So we have a lot of that rocky road ahead of us. You got the war in Ukraine, we've got the sanctions of Russia, you got the rhetoric between COVID and non-COVID. So you've got all these environmental factors that weigh on the market, and then they help with either the structural fundamental aspects of it, how companies operate, i.e. Walmart, Target, some of these that bought the wrong inventory. That's the message they're sending. I don't know. I think they did buy the right inventory. It may have come in later than they expected, or they overbought a little bit in anticipation that supply chain would still cause delivery problems down the line, and they wanted to make sure they had some in reserve. Or it's more as if that people just stop buying, especially high ticket items, and that's probably more like it. Anyways, that employment is soaring. The PMI, the manufacturing index, the Philly Fed had some negative numbers. It did happen to be slowing in that area. I haven't seen it nationwide yet. It's getting near 50 or below 50. Will it, say contraction, right? So we've got the inverse of the yield curves. We've had that a couple of times. We now have the second quarter recession. So technically, those two items declare a recession. It has been in the past. We've used this as indicators, and we're going to continue to use those. In addition to that, we've got the PMI, and the unemployment is really the last two legs to hit. And then ultimately, we know the Fed's raising rates. We know the Fed's going to raise rates again in September. Powell get a very, very dovish tone to his speech, saying that we're going to be data dependent, which is the right thing to do. The markets took that as, hey, we're getting near the end of raising rates. I don't know. I mean, I've said this in every, segment. Inflation doesn't start overnight and it doesn't end overnight. This is a really tough situation where there's so many factors. People aren't taking jobs at the lower levels because they've got alternatives or they found other ways on the gig economy to make similar amounts of money. People are feeling a little bit more flush because they know that, or being told that they can get a job elsewhere. So but they're still not going to spend that type of money until they feel they've got extra cash in the pocket. even though their pay scale has gone up and the minimum wage has gone up, inflation's eaten that, so we're on par, and yet everything's more expensive. The restaurant, the gas station, the grocery store. So everybody's paying a little bit more. The small businesses are really finding it hard to pass on those. So this is a situation that's going to lag for a while. We're not going to all of a sudden stop, uh, or reduce interest rates, and that's what the market's predicting. We'll go over that as well. So we talked about all that. We'll see what happens, but we definitely see the recession has hit, and I would expect we'll probably have a third quarter of negative growth coming up. All right, what's this all mean? Well, what's really going on? Bond yields are dropping. That signals two things. One, money is definitely flowing from overseas into the U.S. The dollar is strong. It's coming back a little bit. I don't know how much it will pull back. There's something to watch, because if it pulls back dramatically, then commodities are going to race to the moon. But what's going to happen is this: the Europe's in debacle. You've got all kinds of issues going on in other nations. They're funneling into a safe haven of the U.S. They're buying up treasuries, which is a good thing because the Fed's supposed to be running off their balance sheet. I saw that they bought $3 billion last month versus running it off. I can't substantiate enough articles, but take a look, do a deep dive on that. I'm suspect that the Fed's really rolling off. They didn't say anything about it in their meeting. But anyways, that is driving the yields down, not up. We would suspect with rising inflation, yields would have to go up. So there's an appetite for U.S. bonds. We're in the TLT, we're in the short-term and long-term government bonds or treasuries, and we're also in corporate bonds. And they pay pretty good dividends, 2.5%, sometimes 1.9, something of that nature, and we're up. So, don't fight what's going on. That's all telling the market. The stock market looks 6 months ahead and is saying, hey, we're going to ease rates. Well, are we easing rates in 6 months? We might be raising rates, but I don't think we're going to go into reverse, but the market sees it that way. If yields come down, and we're going to look at the chart, where could it go? It's a predictive business. I'm not in the prediction business, excuse me, but we need to look at where it could potentially go. If it does come down further, the yields, interest rates on credit cards and mortgages are going to come down and continue that spiraling effect of buy, or invest, alternative invest, and hence, keep prices up. So it's going to be an interesting one. The dollar is slowing from its parabolic climb. We'll look at that as well. Government bills on spending, chipping this inflation green package that they've got out there. That's a lot of billions and billions of dollars. Call it corporate welfare, call it corporate incentives, call it buybacks to people, whatever you want to call it. Its reality is it's money that's flowing. Billions of dollars is going to be pumped into the economy with the infrastructure that's going to go somewhere. We know some of it goes to unions, some of it goes to actual development, some of it goes to graft, some of it goes to actual, end game positivity of growth. But, all those things are going to eat into that money package. So when you got a lot sloshing around, it probably doesn't slow inflation, but it's akin to, adding to the supply side needs. What does that mean? Everybody's going to be trying to buy the same stuff, in these companies race to begin their, build of manufacturing and research and et cetera. So that's going to be more demand. The akin to, when everything was, we were in the Russian Cold War times, we were putting money into the military complex, and General Dynamics, Raytheon, all these companies were getting government subsidies, if you will, and to build bombs, missiles, and technology, whatever it is, radar, and it really drove the economy there. Hired a lot of engineers and even blue collar workers to build the stuff. It really pumped a lot of money into the area of hiring, which was interesting. So this probably won't be. It'll probably be dissimilar, just a different area. We've got all our sell signals, diamonds, Qs, SPY, as well as the small caps. So that's the take. All right. So where does that bring us to? Well, we're gonna have to start nibbling into longs, DI, SPY, Qs, IWM. We're gonna go via the Schwab ETFs. SCHX is the and SCHB. The B is the broad market. CHX is more the higher Dow type component, and then XLK is a smaller cost, but it is basically mirrors the Nasdaq. That's not a Schwab. That's just a general ETF. And SCHA is Schwab's small cap. So we're going to dive right into those right now. Let's look at making SCHS. SCHX. All right. So this is similar. It's large cap, similar to the Dow. Okay. So we got our buy signal back here on 719. My bias said wait. We did wait, and it has run off pretty well. We've got a small little bit of Fibonacci ABC here. So we've got probably 44 to 47. So we got 3-point ride. We've got 46 to 49. We're pretty much here at it. I would expect that we're going to top out at this trend line up here. Okay, it's going to be probably right about there, and then so we're at the peak. If you nibble here, I wouldn't go too long, but we're going to get it. We're going to try to, and it's quite a big gap, so we're going to try to play a big bounce and get a small gain. Maybe if you get in somewhere at 48.4, and you can get 49.3. So we're not talking about a big gain here. If it does break through this little sideways action here, then we're going to see a run up to the 200 EMA. So it's above the 50, and it's above the 9 and above 14. All right, so that's the broad market. Use that. SCHB is the broad market. It mimics the S&P. Same story there. It's a little bit closer to our probably our trend line issue, and we're looking for a few points here. If you get in somewhere today or any pullback, you're trying to get like 47.8 to 49. So there's not a big gain. The gain's kind of already happened here, and like I said, my bias kept me from really in that buy signal. But at this stage, this is where you get caught, so you got to be really careful. The other one is XLK, which is the Nasdaq, and that a similar story is already bumping up against 200. So I haven't even bought this yet. I'm waiting. I got to buy around in the 140s for a pullback, and if I miss it, I miss it. But that is certainly we missed a ride of 10 points there. If we took our buy signal and said, right here when the cross came, we should have bought. Okay, and then SCHA is the small caps. Okay, so there you go. What else are we looking at? ILF is back again. That's our Latin America. ILF has given us the buy signal. If it pulls up, I believe the other day, and it's just starting to break out. So we've got a good opportunity here to get in. It's bumping up against the 50 EMA. That's going to tell us if it's got legs to make the move up, and if it does, we'll be off to potentially get up to the 200. And here's a good example. We've got no buy. We had gap down, gap down, gap down, gap down. So if it does break up above this 50, this is what I'm looking at. See this 50? That's the pink line. If it breaks up above there, we've got there's nothing there to compete with. So it could race right through to that next level, and then nothing to compete here and nothing to compete up there. So it could have a free ride right up to the 200 EMA. Has good opportunity there. And that's our basket of commodities of Latin America. And let's look at the UUP, which mimics the dollar. If that's coming down, as the dollar comes down, commodities will get a little bit more traction. It's abating a little bit. We're getting near our crossover here. It's starting to say a sell signal there for the UUP. If that comes down or goes sideways, that's going to allow commodities to run. So the parabolic dollar is taking off. The other thing was well, before we get to bonds, the other one, it was U.S. Steel. I call this, even though it's a big company, I call it a cult stock because it's a low cost stock and people kind of ride it and they'll buy a lot of it when it's down in the low digits. But we got the buy signal a while back. I didn't really, cult stocks, it does, there's a lot of volume, so that's good. I just get nervous because it can sway really fast. But this is another good play. I got in when it was flat right after the buy signal. So I've been adding to it every time it pulls back. And it does pull back quite a bit. So if it's at, for example, it closed yesterday at 21.7. It had high at 21.8 and the low at 20.98. So, you can get today, it had a high of today of 22.9 and 21.8. So that's a whole point fluctuation there. So you can usually, you can get in at a lower, if you see it fairly, at it high, you can put in a 0.75 below that and you'll probably get ticked off, right? Anyways, the long story is it's running. Should get up to the 200 EMA, and then we've got difficulty here because then you get a lot of buyers and sellers. So there's a pop up to 24.3. We'll see, and we'll take it from there. All right, so we're going to now. We said everything is being parked into bonds. That's what we decided to do. TLT is the long version of the Barclays 20-year Treasury. As bonds, the yields come down. We've had this discussion before. What's the yield on a bond? When you buy a bond for $100, they say we're going to pay 1.2% interest. If the yields come down on the next set of bonds, that means instead of offering 1.2 for that 100, it's offering like 1%. So that's yields coming down. And then if yields go up, that same $100, the next time they sell it is 1.3. So that means yields are going up. As yields go up, the people who hold the previous bonds, their par value is less valued because if I try to sell my 1.2% against somebody who's now earning 1.3 or 4 or 5%, that same $100 is not equal, right? Because I'm going to take the one that's paying me more higher interest. Then the reverse happens, right? So if the yields are coming down, TLT is going to go up. It mimics the inverse of all that. So we had the buy signal way back here. So we've been adding into it. It's kind of hit it's coming back down to the Twomey inside track, the Twomey trend track line. It's getting near the 14 EMA. It may have run its course. We don't know, but it was a great place to park money. You're not going to get a lot of money out of it. But if it does break out, and it just may, if yields break out, it could get up, it could get up to 119.9, with this latest sideways move here. It's almost there now. It kind of hit it a little bit almost. What I'm looking at is because it's using the 50 EMA as support right now. It was using it as resistance, but now it's using it as support, right? Which is a good thing to see. Ultimately, if this market does continue, everything's going to try to reach its 200 EMA. They're all pretty far away, but if it does, wow, that means yields have come way down. But that would be a nice ride. So be careful, get your stops tight. SPTL is the long-term sector United States Treasury. SPLT. Again, we're not going to make a mint on this, but it's a great place to park money. And it's an ETF, you can get it out quickly and you can put stops in it. Same deal there. It's hit its, usually when it's up to the fourth peak of highs, you start getting a pullback. Potentially you could go all the way back, but we're not. It's above the 50 EMA, and if it does break this sideways move, and that's where we are now, it really could get up and just test that 200 EMA. But we don't know, and we're gonna watch it. So that's the Treasury. Do I have other? SPLB is the index of more like the 10 years, so the shorter term. What was that again? SPLB. SPLB. And that's another one you want to take a look at. So we'll go back to that other screen, and you can take a screenshot, and you can start nibbling at some of these if you haven't got it. But we've had these, the buy signal for some time. And so, it's a great place to park money, and if it gets a bump, we'll take it. And all the signs are saying continuation, potentially a nice ride. The other one I had was the corporate VCIT Vanguard. Come on, there we go. Corporate bond index, 5 to 10 years. Let's see, VCIT, and that has a little more volatility, but it's bumping up against the Twomey trend track line. We've had a couple of run-ups here. It's definitely springboard off the 50 EMA. We've got quite a bit of gap between the 9. We did have the buy signal way back here on the early July, right after the 4th of July. So there you go. You want to nibble at these. We're up at an inflection point where it's either going to go sideways. It could come back too. I mean, who knows? What's the relative straightening index on these? These things don't move real fast, but 67. So it's getting in the overbought territory. I'm going to put a little note there. RSI. RSI 67. Okay, alert. All right, so that means it's near overbought. You may want to wait a little bit to see where that goes. All right, let's go back to our others. Let's go back to TLT, for example. I've been watching that. I didn't see an overbought there, no, because it's abated back to 56. So corporate bonds, interesting. They may be in for a breather. Okay. 63 on the long-term treasuries. So we'll see. But you want to take some nibbles. That's good. The other things we're looking at is on the if this bill passes for this green bill inflation bill, blank charging stations, another cult stock. Just be careful. But the buy signal is way back here. It should get up to the 200, right? So as you can tell, that was a big buy the other day when the bill came out, and it's going to probably middle around here somewhere. So just be tight stop. And the other one is TAN, which is ETF. Is it TAN or TAN? Solar Etf. Same thing here. The news came out. Manchin was going to change his mind and, off to the races. I haven't been able to get in this one yet, but I've got some buys in here. I'm waiting for it to flatten out a little bit, from the news. So there you go. We've got a lot of activity. There's some ways to go long. And let me go back to the screen that we want to go back to. There we go. So if you want to take a screenshot of that. So XLU, PAA. So we've got a lot of long. So you can tell as the market shifts, the longs continue to increase here and here. I got back into CPG. CPG is 7.97 now. I got in it. I've been buying it in. It did cross over. There's another one. So we're back in that energy. It's a crazy market, right? Energy's up, energy's down. Yields are up, yields are down. So we're brave new territory. Let me get rid of this. Oh, actually, that's pretty accurate. It's a 0.382 retracement. It's above that. It's heading to 0.5. So we're back in that one, and we know that races pretty well. PAA is the pipeline for energy delivery in U.S. and Canada. and that's kind of a 8, 9, 10% dividend play. It's getting a breakout a little. Pardon me. It's running up, and it's typically sideways, right? Low 10s, maybe 11, maybe 9s, but that's taken off as well. So we had the buy signal on that. We've been in that. We're enjoying a little bit of run here, and we're going to start protecting our profits. What do I say? If let's say you get in around this buy time, and it's run up, or you've added to it. So now we've got this big gap between the 9 EMA and the actual price. Now's a good time to break up your holdings into thirds. First third, just take a hair below the 9 EMA and put your first third stop there, because you got a big gap here. What is that? It's 11 to 10.8. That's a pretty big gap. So you want to protect your profit, especially if you got in down here around 10.2 or 10.5, right? So you get that first stop. The second stop right below the second third right below the 14 EMA, and that is 10.6. And then you hold the last third for the inflection crossover. We never buy at the bottom. We never buy at the sell at the top. But we protect our profits on a run, and this has had a run. I did that with actually U.S. Steel already, and I hadn't been in it that long. And, it came down to the 9 EMA, and I sold some, and I turned around and bought some the same day. So, I'm on this, summertime is a little bit harder to be actively involved, so I'm on it less during the day, but, early and late. So therefore, stops do help. Here again, I've got a nice run up, so I'm going to put a third at my 9 EMA. So that's the kind of things that you want to do, right? So we're off and running. You want to look at all these. There's others, I'm sure, but the buy signals are across the board. And if you start going long on the indexes, just be careful, because we should see a little bit of a pullback, or a tapering. But the market will tell us. So sector analysis, I pulled this one. I sorted it by the 1 month just to get a bigger picture. Because if you go back and let's take the the SPY, right? We look at our daily chart and pull this back a little. It's a busy chart. The trend, from 2022 came down. We had end of February, we tried to come back and reach those highs again. Never made it, and it pulled back straight down. Now we're having a little bit of a rally. We're trying to get into this flat period here in early June. Should tell the tale there, but as you get, most of the time, the 200 EMA has been the playing field. It goes up, comes down, comes down, comes down. So, my guess is that 200 EMA is going to come into play again. But the overall trend, it's still down. The weekly, it clarifies it quite a bit. It is breaking above the Twomey trend track line a tad here. And it really bounced off the trend track line there. So we're getting a nice bump, summer rally. We'll see how long this continues, and we're going to have to watch the manufacturing and employment numbers, really, quite frankly. And it may, but let's take advantage of a few points on that ride. But if we kind of tighten that trend level, let's see what's happening over. No surprise, the last month, IT, so the NASDAQ has got, was the lowest, ended up beating down, and a lot came back into the NASDAQ. Consumer discretionary, industrials, real estate, utilities, healthcare, consumer staples, all the places where probably energy and materials, they're all lower than it was for the year, right? Now, the last 5 days, it's been utilities, real estate, the number 1 and 2, and then we've got industrials up there. Where's energy? Energy is number 1. Pardon me. So, a little more defensive as the market starts to peak here, but we'll see. I think you got to be careful if you go long. That's all I'm saying. All right, here's the one. Advanced decline. Remember, we talk about this a lot. It's well above the. This is why I'm saying we're getting some breath here. There is over the relative strength index is saying it's oversold. So if we go long, it's going to be a very short ride. Okay, the relative strength index 66. Every time it's gotten up here, we've had a market pullback. Every time. Every time. This is going back this year, right? Here drops, here drops, here drops, here drops. I suspect we're going to have the same thing here, and that trend line is going to stay intact. But we've got the MACD way up, so just be careful. I'm looking for a long on some of my hits. They're going to be short-lived, and if that's the case, I'm just looking for a quick profit. These are trading positions, not long-term positions. But if this continues, or the 200 EMA acts as support, that's going to be interesting. So let's see where that's starting to be a bigger picture. We know the support levels. We went over those before. I'm not going to bring them back. The average bear market lasts about 11.4 months. We haven't been in this one quite that long, right? We're probably midway through, and we know where some are retracements. That's our bear market table. And let's see. I've said before, the rallies are, legends. Bear market rallies are legends. We've seen them all. We've been hurt by them all. So if you go long, you need to be careful. That's the Twomey stock market report. We've given you a little bit of an update. We're succumbing to these buy signals. Be careful. We expect them to be a little bit rambunctious here as we start getting into that sideways move back in June. And if it does take off, so be it. I can be reached at jim.net, search at comcast.net, at Twomey Stocks on Twitter. And soon to come, we'll put this all on a live website so you can go in and start pulling at will and then there'll be training videos and setting up all your segments on your stock market. I'm James Twomey. Have a great trading day. Bye now.